We know crypto prices, they're down 60%, both Bitcoin and Ether on a year-over-year basis. And it is interesting that they're trying to stabilize in this range while other commodity prices continue to capitulate. And I'll end right now on talking about the impact of innovation on inflation. We are seeing artificial intelligence training costs dropping 60% per year. And we're seeing mind-blowing breakthroughs in artificial intelligence. So that's a huge deflationary undercurrent, and AI is going to become a part of every industry, every company. And those who harness it the most intelligently and strategically are going to be the winners. Another big drop in the market are focused on valuation and that metric. And yet the bond market does not agree with this at all. In the 70s, bond yields just kept going up inexorably. And that is not happening now. If you look at the 10-year Treasury bond yield, it is having trouble getting above and then staying above 3%. We dropped to 2.5%, for example, in August. And now with the Fed's latest rhetoric, and especially Chairman Powell's Jackson Hole presentation, the bond market has back up into the threes. But we don't think it's going to stay there. And I think that most of the people who believe we're going back into a 70s environment think that interest rates are going to double and then double again from there. If they do not, if these interest rates do not continue to move up, and we do not think they will, the long-term Treasury rate, I'm not talking about the short-term, that's more governed by the Fed policy directly. The long-term inflation rate is more focused on the next 10 years growth and inflation outlook. And so far it's saying that anyone thinking we're back in the 70s is wrong. And I think a lot of price indicators are beginning to corroborate that. The reason we worry about the Fed making a mistake, most difficult times in the market, recession times. I know there's a big debate as to whether we're in one or not. And I know there are perhaps political dynamics at work suggesting that no one wants a recession in a midterm election year. But we believe we're in a recession. And I think the evidence is accumulating that the statistics that we're getting fed day to day and to which the market reacts so violently may be very distorted by seasonal factors. And I'll get into that in a moment. But if we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me. We do believe those are loosening up now. We're getting all kinds of reports that that is the case. And we also did not predict, no one did, the Russian invasion of Ukraine, which has sent food and energy prices soaring, which is a really cruel tax on the consumers around the world. So I've also not been in a period where fiscal and monetary policy during a recession have actually tightened up. Typically, fiscal and monetary policy are contracyclical. In other words, when the chips are down, the economy is in recession, the Inflation Reduction Act and monetary policy tightening, and tightening aggressively. So fiscal policy. We got the Inflation Reduction Act, and as I think many studies have corroborated, the initial University of Pennsylvania analysis was that it would not reduce inflation per se. And yet we probably will see lower inflation. So, I think that the administration will take the credit for that. And frankly, all I care about is that inflation unwinds. But to understand the pro-cyclical nature of this policy, taxes will go up. Now, this is over a 10-year period by $737 billion, and spending will go up by $437 billion, thereby reducing the deficit. Now, if that were correct, and I don't think it will be, these numbers are never really correct, but if that were correct, the deficit would be shrinking. And we do know that federal outlays still are down 15% year over year. So that gets into our GDP accounts, and government accounts for 20% of our GDP. So down 15% in 20% of the economy, that is fiscal drag, and is contributing to the recession we believe we're in. On monetary policy, the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation. And as we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08-09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change